What do you do when you're in need of extra capital? Get a second job? Sell some of your belongings? Or go to a bank and take out a loan? Everyone has his own preferences, but what we might all agree on is that there are only so many hours a day you can work. You run out of things to sell very quickly, and traditional banks can dig a hole so deep you may never get out. We all know the ease of use that credit cards have to offer, as it enables you to spend the bank's money only to repay them afterwards with ridiculous interest of up to 20%. Of course, there are cheaper ways to get a loan, such as a secured line of credit, where you provide the bank with something valuable as collateral, such as a house or a car. If you can provide the bank with all the proper documentation and a decent enough payslip, this might be the best option for you. However, keep in mind that in order not to lose that collateral, you need to make sure not to be late on any of the scheduled payments. Traditional banks want their money back sooner rather than later, as well as the interest, which is still around 3 to 6% on average. That's why I want to talk to you about liquid loans, a fully decentralized lending protocol built specifically for PulseChain. Its operations are completely immutable and governance-free. There are no employees that have to get paid or that are able to make any changes to the code running this crypto bank. It can't be altered, and it can't be stopped. This enables the protocol to offer interest-free loans to whomever and can be repaid whenever, or not at all for that matter. I'll explain the ins and outs of the protocol as simply as I can, but before I do, bear in mind that there's no financial advice on this channel. I'm just gathering the facts, so my lazy friends don't have to. The first thing you need to know is that this protocol is built around its own stable coin, USDL. It is designed to hold the value of the dollar and can be minted when users deposit PLS to the protocol, which is the native coin on PulseChain. In this case, the PLS will act as a collateral to the USDL that is being borrowed. This is very similar to a traditional secured line of credit, with the difference being that it's run by smart contracts with no admin keys, blocking out any human interference. To take out a loan, you have to open up a personal vault, where PLS is deposited on one side, after which USDL will be minted on the other side. The protocol only charges a one-time borrowing fee, usually around 0.5%. There is no interest, and there is no repayment schedule whatsoever. The only thing you have to bear in mind is that the value of your collateral has to remain above the value of your debt by a minimum ratio of 110%. You can simply adjust this collateral ratio by adding more PLS to your collateral, by repaying some of your debt, or by taking your chances that the price appreciation of PLS will take care of the ratio by itself. Whichever you prefer, you need to know that the second a vault falls below the minimum collateralization ratio, it is considered under-collateralized and becomes vulnerable for liquidation. To ensure that the entire stable coin supply remains fully backed by collateral, any user can liquidate a vault as soon as it drops below the minimum collateral ratio. The one who does receives 0.5% of the vault's collateral and will be compensated with 200 USDL for gas expenses. This USDL is taken out of the liquidation reserve that is set aside whenever anyone opens up a vault. Anyway, whenever a liquidation has been set in motion, it's for the stability pool to act as a first line of defense. This pool can be funded by users of the protocol by transferring USDL into it, so that whenever a vault is liquidated, an amount of USDL can be taken out of the pool to repay its debt. In return, the collateral from that vault is distributed to the stability pool providers. This means that they will lose a share of their USDL deposits over time, while gaining discounted PLS, as vaults are likely to be liquidated at just below 110% collateral ratios. For example, if the stability pool needs to transfer 100 USDL to repay a vault's debt, it will most likely get around $109 worth of PLS in return. Besides being awarded with discounted PLS, stability providing is also incentivized by the secondary token of the protocol. The loan token is a way to become a co-owner of liquid loans. You can deposit this token into the loan staking pool, for which you'll be awarded with a share of the fees generated by the system. These staked funds can be withdrawn at any moment, so instead of just holding or selling the accumulated loan rewards, you can go ahead and stake them in order to earn USDL and PLS accumulated by the system from both the borrowing fees and the redemption fees. Important to know is that redemptions are not the same as paying back your own vault's debt. Redemptions pay off the debt of the riskiest vaults in return for their collateral, even if it's higher than 110%. Any holder may redeem their USDL for $1 worth of Pulse at any time, whether or not they have an active vault. This is why you need to make sure you adjust your vault's collateral ratio whenever it's relatively low compared to the rest of the vaults in the system. However, if your vault gets redeemed against, you won't suffer any losses. You will only lose some of your PLS exposure. The only way you would lose any funds is if your vault gets liquidated, and even then you would only lose about 9%, as you get to keep the borrowed amount of USDL. To never get liquidated, you have to respect the 110% minimum collateral ratio, but it's advisable to mark the 150% level as the absolute minimum, not only for the risk of getting redeemed against, but also to not be on the wrong side of this ratio when the protocol falls into recovery mode. This is a failsafe to ensure the health of the protocol and kicks in whenever the collateral ratio of all of the vaults combined falls below 150%. If yours is one of the vaults pulling on the wrong end of the total collateral ratio, it is vulnerable for liquidation. During this period, users won't be able to do anything that pulls down this ratio even more, and to incentivize behavior that does raise the total collateral ratio back above 150%. There will be no fees for borrowing at a higher collateral. Recovery mode acts as a last line of defense to ensure that one USDL remains redeemable for $1 worth of Pulse at all times. Liquid Loans was designed to allow owners of PLS to extract value from their holdings without the need to ever sell their tokens. If you're planning on setting up a vault, a collateral ratio of 500% or more is considered to be a less risky move. This way it can withstand sudden volatility in the crypto market, which eliminates the need to check up on your vault every single day. There are several strategies out there on how to maximize profits by using this protocol, so be sure to check those out before creating a vault. If you did so already, do let us know in the comments what your strategy is and why it's the best option for you. That being said, the protocol can also be used without opening a vault if being in debt isn't for you. You can buy both tokens on the open market and take advantage of the pools by earning loan, PLS, and USDL. You can even arbitrage USDL whenever a decentralized exchange offers it for less than $1, after which you can redeem it for $1 worth of Pulse from one of the riskier vaults. Whatever you're planning, be sure to do some research before making any moves. There are some useful links in the description, and if you have any questions, let me know in the comments section. Like and subscribe if you haven't already, and click the bell icon to get notified for more content like this. Thanks for watching, and see you in the next one.